Okay, great. Thank you, Adrian. Welcome, everybody, to our continuing series of webinars where we discuss the current inner circle strategies and trade recommendations. And our goal with the webinars is to help you members implement the recommended trades and also to provide some understanding behind the trade selection process. And today we're going to focus on selecting an option strike price. And in previous webinars, we looked at our technical indicators and fundamental indicators that we use to select stocks that we want to purchase options or create an option spread. Today we're going to focus on selecting an option strike price, and that can be just as important as the stock selection process. In other words, once you do your fundamental analysis and technical analysis and you find the stock that would be a good candidate, let's say for a call option purchase or a buy right trade, the next challenge is to select a strike price. And with a lot of the liquid stocks today, you could have 300, 400, 500, even 700 strike prices to choose from. So today we're going to try to go through the thought process that I use to select strike prices. And I know I've gotten a lot of questions on this in the past, so I just want to take you through the logic that I use in selecting strike prices when I make trade recommendations. So due to the time decay characteristics of options, when we're buying an option, we want to minimize time value. The time value is a decaying asset. So whenever you're long an option, every day there's time value decay with the value of that option, and options decay faster as you get the time decays faster as you get closer to option expiration. So when we buy an option, we want to minimize that time value and maximize the intrinsic value. That way you don't lose a lot in the time decay of the option. And when we sell options to create a buy right trade or an option spread, it's just the opposite. We want to maximize the time value because, as you know, all time value decays to zero at option expiration. And if you're short a call option, that time decay becomes your profit. So let's say you sell an option that has 2 points of time decay. Well, at option expiration, that time decay will take the time value to zero, so that 2 points becomes all profit, no matter which way the stock trades. So when we're option sellers, we're focused on that time value, and the time value becomes your profit. Okay, and as we looked at in previous webinars with our technical screening, we use our trend following systems to determine the price trend. Then we confirm the price trend, and then the third step is we use the Keltner channels to determine an entry point. And we also use fundamental screening. We look at the growth in equity of a company, growth in retained earnings, and we also check the revenue growth just to verify the growth in equity and the growth in retained earnings. And the other fundamental screen we use is dividend growth, and we looked at that in a previous webinar, and we like to purchase dividend stocks that have a history of consistently raising their dividend. And of course, the dividends are paid in cash, so corporate directors are not going to raise that dividend unless they think there's the future earnings potential. They want to make sure that future earnings potential can cover that dividend increase. So they usually are not going to raise that dividend unless they know that the future earnings can cover it. So that's another fundamental screen that we use. So once we conduct that fundamental and technical screening and we pick out a stock that let's say we want to buy a call option on, of course the next step is selecting an option time length and also selecting a strike price. And as I mentioned, you could have 500, 600, 700 strike prices to choose from. So as far as the time length, if you're purchasing an option, I like to go out 3 to 6 months. And I know from my historical data research, it's better not to purchase the shorter term options, let's say a 1 month or a 1 week option, because there's only maybe a 50 or 60% chance with most stocks that a monthly or short term option would be profitable. So when purchasing options, we like to go out 3 to 6 months usually, and sometimes we'll also purchase leaps options just to diversify our option purchase portfolio among various option expiration dates. This allows you to reduce the risk in your portfolio when you stagger those expiration dates. But most of our purchases fall in the 3 to 6 month category. Now, the time length when you're selling an option is just the opposite. The shorter, the better. In other words, a 1 week option, the time decay is going to be very fast, and the time value will go to 0 after 1 week, and then you get to keep that time value if you were short, let's say, a call option. And so it's better to have shorter time lengths with short options, so you can collect on the time decay quickly. And the options time decay really accelerates when you get close to expiration. So the closer you are to expiration, the greater that time decay is going to be. So let's take a look at a general rule I use for option purchases. And I've been trading options for over 27 years. And as a general rule, if I'm buying an option, I like to limit that time value to less than 1% of the stock price per month. And if you limit that time value to 1% or less per month, then it doesn't take much of a move in the stock to break even on the trade. And you have a higher probability of success than if you buy an at-the-money option or out-of-the-money option. And we'll look at 2 examples here that will explain that. And this first one we're looking at is, this is an option quote for Apple on Yahoo Finance. And this is back when Apple's trading at 173.25. And you can see the quote for the 185 strike call, it was 315. And if the strike price of 185 is higher than the price that the stock was trading at the time, then that would be considered an out-of-the-money call. And of course, this 315 of time value or this 315 premium is all time value, and there's no intrinsic value with an out-of-the-money option. Out-of-the-money options consist of only time value. So in order for this trade to break even, this is about a 1-month option. In order for this trade to break even, you have the strike price of 185. The premium was 315. So the stock would have to trade up from 173 to 188 over a 1-month period for this trade to break even. So that's about an 8.6% increase in 1 month for this to break even. So, there's not many months where a stock's going to go up 8.6% in 1 month. Now I know lately Apple has been probably increasing in value that much, but that doesn't occur very often. So you want to always go with the best odds, and the odds are that a stock's not going to go up 8.6% in a month. So if it doesn't go up this 8.6% in the month, then you lose 100% of that option premium that you paid. In other words, if the stock doesn't get up to this break-even price, then you have 100% loss on this premium. So, we don't want to take a risk where we're going to lose 100% of our premium in a month. And in a lot of cases, with these out-of-the-money options, you could have 100% loss or 50% loss in just a day or two. So they're very volatile. It's really hard to make consistent profits with this type of a trade. And the other disadvantage of these out-of-the-money purchases is that they don't allow us to use our money management rules of exiting an option purchase if the value of the option declines 25 to 35% from our entry price. So with these out-of-the-money options, you could have a 50 or 100% or 90% loss in just a few days. So realistically, it's just not practical to use money management with that type of a loss that could occur so quickly. So it doesn't allow us essentially to use our money management rules. Now let's look at it in the money call purchase. And again, this is a quote when Apple was trading at 173, and the 150 strike call was trading at 24.60. And of course, if the strike price of 150 is less than the stock price, this is an in-the-money strike price. And what I did is I plugged in these numbers into the call option purchase calculator, buying the stock at 173.25, or the stock was trading at 173.25. We bought the 150 strike call at 24.60, and the calculator will calculate the time value and intrinsic value. So remember, when we're purchasing an option, we want to minimize the time value and maximize the intrinsic value. So in this example, this option had 1.35 points of time value, 23.25 points of intrinsic value. So you can see it's almost all intrinsic value. And the time value portion is 135. So Apple stock only has to go up 1.35 points for this trade to break even. And that translates to about a 0.7% price increase for this trade to break even. So you can see where these in-the-money purchases have a much higher probability of success. And they also allow us to use the money management rules. And we can, and we have in the past, exited option trades when they had a 25 to 35% loss. So, I'll gladly take the 25 or 35% loss than a 100% loss. So, this allows us to, these in-the-money options allow us to use the money management principles. So I just took a snapshot here about an hour ago of my one of my option portfolios, and I used the fundamental indicators and technical indicators we mentioned, and also the strike price selection for this portfolio. This is an option purchase portfolio, and this currently has average return of 65.8%. And let's take a look at the inner circle option portfolio, and as of the close yesterday, we had a $152,000 open trade profit, average return of 143%. And again, we used the fundamental and technical screening to select these options, and I also used the high accuracy trade selection process for the time length and strike price selection. So we currently have a real good return, average return on the portfolio, and as we get closer to expiration on these options, for the newer members, when we get close to expiration, we'll normally roll over an option if it's profitable, and this allows us to compound our returns. It reduces the cost basis of the new option. So any profit we have on the existing option reduce the cost basis of the new option. And this trade right here was for Apple, and we bought this option in January, and we just rolled this over a couple days ago, and by rolling it over, it reduced the cost basis of our purchase that we made last month, and now we have an open trade profit of 813% on an option that we just bought last month. So rolling over allows newer members to get in on these trades, and also allows us to compound our returns. And I wanted to also talk about selling options, and I've learned through experience when you're selling an option, an at-the-money strike is probably the best level of strike price, because it provides both income from the time decay and also downside protection. So at the money, that's kind of like the sweet spot for if you're going to sell option premium. Maybe slightly out of the money or at the money options, I found through experience are the best strike prices for selling options. Of course, again, this is just the opposite of buying. So here's a snapshot I just took of my buy right portfolio, and it lists the stocks up here, and then the short options down here. And again, I use the fundamental and technical screening to select these buy right trades, and then when I'm selling options, I sell at the money calls. And most of these are weekly options that I sold at the money last week, and that works out really well, because as I mentioned, the weekly options, the time decay goes to zero over a 1 week period. So it decays very fast over that 1 week period. So if you're short options with weekly options, you get paid over a very short period of time. And this has been working out real well for me. And in the near future, I'm going to start making trade recommendations for weekly options. We're going to start trading those I've been doing those for about 2 years now, and it's been working out pretty well. So, all right, well, that concludes my presentation for today. Today, we just wanted to focus on selecting the option strike price, just so the members have an understanding of the thought process I use in selecting strike prices. So that concludes the presentation, and I'd be glad to take any questions. And Adrian, do we have a question board here?
Chuck, we have 2 questions that have come in. Actually, a lot of questions that just rolled in. I have 2 of them in the chat section. Do you see the Q&A?
Okay. I'm looking in the chat section right now. Is that where the questions are?
Yeah, I'll go ahead. I'll put the other ones in the chat section now.
Okay. Okay, here's a question. Do the calculators presented in the spread and options calculator require holding the option all the way through to expiration day? No, they don't. Anytime you have an option trade on, you can always exit that trade prior to expiration, whether you're short or long an option. So the calculator is simply helps you in getting an idea of what the profit loss potential is for a trade before you take the trade. And it assumes that you hold the trade to expiration, and that's what the calculations are based on, but you don't necessarily have to hold the option to expiration. As a matter of fact, with the option spreads, we'll usually exit those or roll those over when we reach about 90% of the profit potential for option spreads. Okay. When you use at-the-money calls, how long? Just a week or the front month or longer? And when you're selling the at-the-money calls, I do it mostly for weekly options now, but I used to do mostly 1 month or 2 month at-the-money sells when I was either creating a buy right trade or an option spread trade. The option spread trade last year, the time lengths were a little longer than that, just because the markets were so volatile. It was better with those option spreads to go deep in the money and to go out several months, because you had a better chance of staying in the trade and not getting stopped out. So that would be the exception for when you're selling options at the money calls. On the option spreads, we do it a little differently during volatile markets, and we like to go out a little longer on the time frame, and we like to go a little deeper in the money just for the downside protection during volatile markets. But to answer your question, with the buy right trades, I'm doing mostly weekly buy rights with that, and the sweet spot for those for selling an option is at the money. Okay, here's a question. Is it common for you to hold the same security in 2 different strategies? For example, the Apple 440 call in both the option and option spread strategies. Yes, it is common for us to do that, and some members aren't authorized to trade option spreads in their trading account. So what we do is we track just the option trade, the option purchase in the option purchase portfolio, and then we also, for those members that can take the spread, trade, we also track the spread trade and the spread portfolio. So, yes, it is common to have both an option purchase and an option spread on the same stock. Okay, how is the rollover strike price determined on an option trade? And it depends if we're talking about an option purchase, then the rollover is going to be, we're going to follow the same guidelines we would do if it was a new purchase. In other words, it's going to be an in the money purchase with less than 1% of time value per month as compared to the price of the stock. So when we roll over, we use the same principles for the strike price selection. Okay, let's see what else we have here. Can the dividend payout of a particular stock be found on the balance sheet as part of the fundamental screening? The dividend payout, the history of dividends, you can find on Yahoo Finance. If you type in a stock symbol and then you click historical prices, it'll display all the prices, the daily prices for a stock, the open, high, low, and close, and it'll also include any dividend payouts. So you can look at all the dividend payouts for a stock, the amount of the dividend, and the date of the dividend on Yahoo Finance. Okay, I think that's it for questions, and I want to thank everybody today for listening, and looking forward to our next webinar presentation. Have a great day, everybody.